Hi, this is Scott McLeod from Brown Financial Advisory. Wanted to spend just a few minutes with you talking about what's happening in the markets. We've just released our quarterly performance report, and the markets haven't given us much to work with over the last 6 months. So I thought I'd give you a little perspective on what's going on right now. First of all, here is our agenda. The first thing is we're going to talk about what's happening in the global stock markets. The second thing is I'd like to talk with you about what's happening in the economy. And the third thing is how to process this type of volatility. This is not an unprecedented amount of volatility, but it's some volatility that we haven't seen for a number of years. So how do we really relate to this, and what should we consider as our next expectation for the market over the next few months? So let's get started. The first thing is what's been happening in the global stock markets. And as you know, we've seen declines since the first of the year. In fact, as things kind of wrap up right now, we're seeing as of Friday, market declines in the 16-17% range for the U.S. market, right around 20% for international markets. And even the bond market is down about 10% for the year. So while this is not unprecedented, it is some of the largest declines we've seen in a while. Now, 2020 was down about this much, but it didn't last for very long. But in the face of a recession, these declines are a little bit unusual, and we haven't seen these type of declines since 2011 or so. So the question then becomes, what is going to happen in the U.S. economy? And as the Wall Street Journal shared a few weeks ago, if we are in recession, it's a very strange one. And basically, that's the bottom line right now. It is uncertain as to what's happening with regards to the economy. The Fed has been raising interest rates with the intent to slow the economy, but jobs, for example, we have 11 million open jobs in the U.S., and the hiring is great and unemployment is low. So that's a dichotomy when it comes to recession, and it makes this particular type of recession a little bit different. However, the question has been, are we going into recession or are we not going into recession? And I'll just call it for you right now. I think we have a very high probability of being in recession. In fact, the Atlanta Fed has already said in their GDP Now release that we are there for the second quarter. Their projections say that the second quarter is going to come in at a -2 to -1.5%, and that's not unlikely. So if I call it, it's probably not a scary thing, because if I'm wrong and we don't end up in recession, then that's a positive thing and you'll be pleasantly surprised. But if I'm right and we are, then you're probably not surprised at all, because it certainly feels like, especially with the market and the media, that recession is a pretty high likelihood. So what then do we do as we try to process this volatility? How do we get comfortable with what's happening right now? The way you do that is you put it in the right frame of reference, and that means time. How do you process it in terms of time? Let me show you a couple of examples. The first thing is with regards to the bond market. The bond market is down now more than we've seen in 50 years. And that is as the result of rising interest rates, when interest rates started at a very low rate to begin with. This chart shows you the 10-year Treasury yield from 1962, I believe it is. And this particular chart goes all the way back and shows what happened to the 10-year Treasury in that time frame, peaking out at around 16%, dropping down to well into the low single digits. And now you can see it's spiked over the last year or so. Anytime you see an increase in the yield of the 10-year Treasury or other bond yields, you're going to see a decline in bond prices. But they're not always one-to-one in terms of the increases and the declines. So if you look at the performance of the Barclays Aggregate Bond Index over that time frame, what you'll see is that modest returns occur whenever there are rising rates, like during the 70s and 80s. And then when you see falling rates, the increases are dramatic. And during those times where we see negatives, which are the highlighted versions, the years that follow are almost always double-digit returns. So you can see these dramatic increases in returns after the negative or 0% returns on the bond market. So here we are now down 10%. It's the second year in a row that we've seen negative returns. That's unusual in terms of the Barclays Aggregate Bond Index for it to be down 2 years in a row. It would be even more unusual for it to be down 3 years in a row. And so going into next year, I think we have a pretty high probability that interest rates will settle. And when they do, we'll see those dramatic performance increases in the bond market. So I think the declines in the bond market will be relatively short-lived. but it has a significant impact on our portfolio because that's supposed to be the safety net. When we see the stock market decline, typically we see slight increases in the bond market, and we're not seeing that at all. So both sides of the portfolio have declined, and despite all of our mitigation factors, the bond market is struggling right now. So we do expect to see some recovery in the shorter term, sometime in the next few months, but it may take a little while to work that out as the interest rates settle back down. Now, what about the stock market? How do we process this 20% decline in the stock market? Well, let's first put it in perspective. The concept number one that I'd like for you to remember is that volatility like this is not uncommon and it's not permanent. So you can see various levels of volatility throughout the market. How frequently do they occur over time? So we see 5% declines on average about 3 times a year. So the market runs up and runs back 5% very frequently on average, and it's not uncommon to see a 5% decline. In fact, when the market we see an actual correction in the market, which is defined as a 10% decline. Believe it or not, that happens once a year on average. So I wonder sometimes when we get worked up about 10% declines, because frankly, that happens so frequently that we should expect a 10% decline on a regular basis. Once we get out to 15 and 20% declines, those situations are a little bit different. 15% declines only occur about every 3.5 years. 20% declines only occur every 6.3 years. So it's been a long time since we've seen a 20% decline that was significant like this one. Now, we saw the blip in 2020, which was a little bit of an anomaly because of COVID, but we haven't seen a decline like this really until about 2011. And that's you going back, and we saw a 15, 20% decline in that time frame. So this is a little bit unusual for us, and we've had a nice long growth period since our last decline like this, which makes it feel especially acute. But when you consider if you're in the long-term investing game, which we all are, 6.3 years is really not a very long time to wait to see that 20% decline. But here's what I want to point out more than anything else. We're here now. We've seen 20% declines in the stock market. On average, that time frame is about 425 days. So what that means then is when you're looking at top to bottom and then the recovery, the average time frame for that is 425 days. Do the math, it's about 14 months. So that's about February of 2023 since the decline started in January of 2022. So the question that I would pose after concept number one is if you thought that this would only last for, I don't know, another 8 months or so, how would you feel? It would be reassuring, wouldn't it? Because you know the portfolio will begin recovering after that. On average, that's what's happened. So there have been many times that it's taken less time than that, and a few times that it's taken more, but on average, about 14 months. So if we go with the average, we really don't have that far to go before we start into recovery. The next thing that I want to share with you is the magnitude of the recovery. So this chart is really interesting because it tracks all the way back to the Great Depression and through 2011, which was the last time that we saw, excluding 2020, the last time that we saw declines of 15%. So when you look at this chart, what you see is that you see the time frame that it takes to recover and the magnitude of the recovery. So over this time frame, every time the market has declined 15% or more is tracked in this chart. And you can see the average recovery time from the bottom is 12 months and 55%. So after we hit that bottom, the next 12-month time frame is a 55% return on average. Now I'm going to throw out a couple. If you look at the top of the chart here, you'll see the Great Depression is included in that, and there are a couple of outlier returns in that Great Depression time frame. But if you just draw a line about right here where the average is, you're still looking at a 40% return over a 12-month period. That's the return after the decline. So if you go to the previous chart and you say 20% declines typically start resolving themselves after 425 days, that means that starting in February on average, we would project that forward the next 12 months, the average return could be somewhere in the 30 to 40% range. That's remarkable. And if you knew that was going to occur, what would you do? You'd stay invested. You might even invest more. So that's what I want to emphasize as well. Now, finally, I'm going to give you one more element to kind of put it in a time frame that makes sense to you. So this chart is the growth time frames versus the contraction time frames on the S&P 500 at 20% bear market. So the previous chart was 15%. This is 20%. And it tracks back to about 1949. So if you go back, you'll see here that we've had a number of bear markets. It's all of these declines at the bottom of the chart. So a number of bear markets that fall in there. But we've also seen enormous growth in the market in those time frames as well. How do they compare? Well, the average bear market is a negative 33% return. So we're nowhere near that average right now. And the time in that bear market is 14 months. So the beginning of the bear market to the end of the bear market, on average, 14 months. That's consistent with what we talked about just a few minutes ago, and that would be February of 2023. However, if you consider the growth timeframes, what do you have? The average total return is 263%, and they last 71 months. So what we find is that we see these periods of volatility, but they pale in comparison to the upside of the market. So maybe we see a more volatile market in the fall as the Fed continues to raise interest rates. Maybe the market even declines further, maybe close to the 33% average. However, on average, only about 14 months for most of these declines, most of these bear market periods. And then the period that follows averages 263% and 71 months. So that means if you're going to do anything, you want to be invested, you want to stay with it. And if you have the extra resources, it's a good time to invest. It's a good time to do the other things that we've talked about. So what do we do in times like these? You're not a victim unless you allow yourself to be victimized by this market. So what I would encourage you to do are these 5 things. The first one is consider the Roth conversions again. Look at your tax rates. We'll do the analysis for you this fall and see if it makes sense for you. But at a 20% decline, lots of Roth conversions make sense. So we want to take that into consideration. The next one is the tax loss harvesting. You'll see in our quarterly report, we've already captured nearly $3.5 million of tax losses this year. That means we've just sold, reinvested in something similar, kept the portfolios in the market, but we've pocketed those losses. On average, that's going to save our clients about $1 million in total. And then number 3, rebalancing into those asset classes that may be lower in valuation. So we're looking at those asset classes and things that fall out of that valuation range, we want to invest in right away because they're cheap. So the market will give us opportunities like that, and we capitalize on those in the portfolio, and we're constantly analyzing the portfolio to take advantage of those things. The next thing is on you. If you're taking a monthly distribution, we'd ask you to stop the distribution because the distribution exacerbates the declines. So if the market is down 20%, for example, and you're pulling money out, that just makes it very difficult for the portfolio to recover in a robust fashion. Stop the distributions, lean on your emergency fund, lean on your home equity line of credit. Let us know that you're ready to stop so we can put it on pause. And then once the market recovers, we'll restart, we'll pay off the home equity line, and we're back in business. And then the last thing, of course, is just be patient. It's a time that we want to make sure that we're patient with the market because it goes through cycles like this on a relatively frequent basis. If you consider every 6.3 years, that's not that long to wait for a cycle like this, but it has always recovered, and it always recovers in a robust fashion. You just have to be patient with it and have confidence in the market to do what it's always done. So I want to thank you for this time. Please let me know if you have any questions about anything that you've seen here. We certainly are honored to have the opportunity to work with you, and hope you'll let us know if you need anything in the future. And I look forward to talking with you again soon. Thanks a lot.